Meet Marcus, 41 years old, project manager in Atlanta, makes $94,000 a year, has a 401k, a brokerage account, and reads the news. He's not clueless. In April 2024, Iran launched over 300 drones and ballistic missiles at Israel. Marcus watched it unfold on his phone. Then he went back to work. He didn't move a single dollar. In the 30 days that followed, gold climbed 6.2%, defense ETFs jumped 8.4%, oil futures spiked 9.1% in a single week. Marcus's account sat exactly where it was because he didn't have a framework. Here's what should bother you. This was never a surprise. The Middle East has produced some version of this crisis on a near-clockwork schedule for 50 years. And every single time, the same 7 assets move in the same predictable direction. Every single time. My name is Bobby, and I spend way too much time thinking about how the crises most people watch helplessly on the news are actually the most predictable wealth transfer opportunities in modern financial markets. Subscribe and hit that thumbs up if this helps you out. Here's the thing. Most people treat geopolitical crises like weather events, unpredictable, random, something to survive, not something to prepare for. They hear about airstrikes or sanctions or blocked shipping lanes and they think, well, I better just stay in cash and wait until things calm down. That is exactly the wrong instinct. And it's costing you. The story we've been sold is that war and conflict are bad for markets, bad for your portfolio, bad for everyone. And yes, broad market indices sometimes dip when tensions spike. The S&P 500 might pull back 2 or 3% on a bad headline. That part is true. But here's what they don't tell you. While the index is pulling back, specific sectors and specific assets are making violent, explosive moves to the upside. And those moves are not random. They follow a logic that is centuries old, rooted in supply chains, military contracts, human psychology, and the physical geography of how the world moves energy. The financial media covers the drama, the explosions, the diplomatic statements, the analysts on TV saying this adds uncertainty to markets. What they rarely do, what nobody does in plain English, is tell you the exact assets that respond to this uncertainty and why they respond every single time. Because if they told you that, you'd stop being scared and start being strategic. And scared people make other people rich. Strategic people keep that money for themselves. Let me take you back to October of 1973 for a second, because understanding the history is crucial to understanding why these patterns are so durable. Egypt and Syria launched a surprise military attack on Israel, the Yom Kippur War. Within days, the Arab members of OPEC declared an oil embargo against the United States and Western Europe for supporting Israel. They cut oil production by 5% per month. What happened next became one of the most important financial lessons of the 20th century. The price of oil went from $3 per barrel in October 1973 to $12 per barrel by March 1974, a 300% increase in 5 months. The U.S. economy went into a recession. Gas lines stretched around city blocks. The Dow Jones Industrial Average lost 45% of its value between January 1973 and December 1974. But here's what the history books forget to mention. Gold went from $97 per ounce at the start of the embargo to $197 per ounce by the end of 1974, a 103% gain. Defense spending surged. Weapons manufacturers posted record revenues. Certain agricultural commodities spiked because energy costs drove up farming expenses worldwide. The people who saw the system, who understood what a Middle East conflict meant for specific assets, made generational wealth during one of the worst economic periods in modern American history. Fast forward to the Gulf War in 1990, Iraq invades Kuwait in August. Oil immediately spikes from $17 a barrel to $36 a barrel. Gold jumps. Defense contractors, companies like Lockheed, General Dynamics, Raytheon begin a multi-year bull run that lasts well past the war itself. Then 2003, the Iraq invasion. Oil climbs, gold climbs, defense budgets explode. From $404 billion in 2001 to $616 billion by 2008. The defense sector outperforms the broader market for 6 consecutive years. Then 2019, the attack on Saudi Aramco's oil processing facility in Abqaiq. In a single day, oil spiked 15%. the largest single-day percentage increase in the price of oil in history. One drone strike, one day, 15%. The pattern is not a theory. It is a 50-year documented record. Middle East escalation moves the same assets in the same direction with a consistency that almost nothing else in financial markets can match. The only question is whether you're positioned to benefit or whether you're watching it happen from the sidelines like Marcus. Let's get into the 7 assets. And I want to be specific here because vague advice is useless. I'm going to tell you what moves, why it moves, and how it has historically moved so you can make an informed decision. Asset number 1 is crude oil. This is the most direct and most immediate response to any Middle East escalation. And the reason is geography that has not changed in 50 years. The Strait of Hormuz, the narrow waterway between Iran and Oman, handles approximately 21 million barrels of oil per day. That is roughly 21% of total global oil consumption flowing through a channel that is, at its narrowest point, 1 miles wide. Every time there is a credible military threat in that region, oil traders price in the possibility of that strait being blocked, attacked, or disrupted. They don't wait for it to happen. They price in the risk immediately. In 2019, after Iran shot down a U.S. surveillance drone near the strait, oil spiked 6% in a single trading session. In 2024, after Houthi attacks on shipping in the Red Sea began disrupting routes around the Arabian Peninsula, oil price volatility hit its highest level in over a year. You can access oil price movement through ETFs like USO, the United States Oil Fund, or through energy sector ETFs like XLE. Futures contracts are available for more sophisticated traders. But the direction of travel when the Middle East escalates is almost never down. Asset number 2 is gold. And this one is different from oil because the mechanism is psychological as much as it is practical. Gold is what economists call a safe haven asset. When uncertainty spikes, when investors don't know whether to trust stocks, currencies, or bonds, they move money into gold. It's been doing this for 5,000 years. It does not stop doing this because we invented the internet. During the 2023-2024 Israel-Gaza conflict escalation, gold moved from roughly $1,820 per ounce in October 2023 to over $2,400 per ounce by April 2024. That is a 31% gain in 6 months. While equity markets gyrated and analysts argued about interest rates, gold was quietly making investors very wealthy. The data from the World Gold Council shows that during 16 major geopolitical crisis events since 1990, gold posted positive returns in 13 of them within the first 30 days of the escalation. That's an 81% hit rate. You access gold through GLD, the SPDR Gold Shares ETF, or through IAU, or through physical bullion if you want to hold it directly. Gold doesn't care about earnings reports. It doesn't care about Fed meetings. When the world feels dangerous, gold goes up. That's not a theory. It's a 5,000-year track record. Asset number 3 is where the real money has historically been made, and almost nobody outside of institutional investors talks about it in plain terms. Defense contractors. When Middle East tensions escalate, governments respond by increasing military spending. Orders go out for weapons systems, ammunition, surveillance equipment, missile defense systems, naval vessels. Those orders go to a small group of publicly traded companies, and their stock prices reflect that demand. Let me give you specific numbers. Lockheed Martin, ticker LMT, the largest defense contractor in the world by revenue. In the 12 months following the September 11 attacks, Lockheed's stock rose 28%, while the S&P 500 fell 12%, a 40-point divergence. Raytheon Technologies, now RTX, produces the Patriot missile defense system. Every time Israel activates its Iron Dome and requests resupply, Raytheon gets a contract. In 2023 alone, Raytheon received over $9.7 billion in international defense contracts, a significant portion related to Middle East defense needs. General Dynamics, Northrop Grumman, L3 Technologies. These are not speculative bets. These are companies with government contracts that last decades, revenue visibility that most CEOs would envy, and a customer, the U.S. Department of Defense, that has never once missed a payment. The easiest way to access this sector is through ITA, the iShares U.S. Aerospace and Defense ETF, which holds all the major players in a single fund. In the 30 days following the October 2023 Hamas attack on Israel, ITA gained 9.3%. Asset number 4 is the one that surprises most people: cybersecurity stocks. Modern warfare is not just tanks and missiles. Every major Middle East escalation in the last decade has been accompanied by a significant spike in state-sponsored cyber attacks. Iran in particular has one of the most sophisticated state cyber warfare programs in the world. In 2012, Iranian hackers executed the Shamoon attack, wiping the hard drives of 35,000 computers at Saudi Aramco, the world's largest oil company, in a single operation. In 2021, Iranian-linked hackers breached the water treatment system of a town in Florida, attempting to increase sodium hydroxide to dangerous levels. When governments and corporations see these attacks spike, emergency cybersecurity contracts get signed fast. Companies like CrowdStrike, Palo Alto Networks, and Fortinet see both revenue increases and stock price appreciation during these periods. CrowdStrike, ticker CRWD, gained over 34% in the 90 days following the major escalation period in late 2023. In early 2024, Palo Alto Networks, ticker PANW, has consistently outperformed the market during periods of elevated geopolitical tension since its IPO. The ETF play here is HACK, the ETF MG Prime Cybersecurity ETF, or BUG, the Global X Cybersecurity ETF. When the Middle East escalates, someone's network is about to get hit. The companies that stop that are worth owning. Asset number 5 caught a lot of investors off guard in 2023 and 2024. Shipping and logistics companies. The Red Sea handles approximately 12% of global trade. It is the most direct maritime route between Europe and Asia. When Houthi rebels in Yemen began attacking commercial shipping vessels in the Red Sea in late 2023, something remarkable happened. Ships started rerouting around the entire continent of Africa. A journey that took 11 days now took 25 days. Shipping costs exploded. The Drewry World Container Index, the benchmark for global shipping rates, increased by over 173% between November 2023 and January 2024. Companies that own container ships and tankers saw their stock prices move violently. Frontline, ticker FRO, one of the world's largest oil tanker companies, saw its stock rise 47% in the 90 days following the Red Sea disruption. Nordic American Tankers, International Seaways. These companies became extraordinary performers, not because of anything they did, but because the geography of conflict rerouted the world's commerce through their vessels. When Middle East tensions close or threaten to close key waterways, the companies that own the ships taking the long way around get paid dramatically more. That pattern is now documented across multiple escalation cycles. Asset number 6 is one that almost no retail investor thinks about when they hear Middle East crisis: agricultural commodities, specifically wheat and corn. The mechanism here is energy costs. Modern industrial farming is an energy-intensive process. Fertilizer production is heavily dependent on natural gas. Diesel powers the tractors, combines, and trucks that plant, harvest, and transport food globally. When oil prices spike due to Middle East tension, farming costs rise almost immediately. And when farming costs rise, food prices follow. But there's a second mechanism that is specific to this region. The Black Sea, the primary export route for Ukrainian and Russian wheat, is geopolitically linked to Middle East instability in complex ways that have become more visible since 2022. When the broader geopolitical order is under stress, grain supply chains tighten. During the 2022 Russia-Ukraine conflict, escalation itself connected to a broader global geopolitical environment that included Middle East destabilization. Wheat futures spiked 70% in a matter of weeks. Corn followed. The agricultural commodity ETF corn gained 42% in the first half of 2022. DBA, the Invesco DB Agriculture Fund, which tracks a basket of agricultural futures, gained 25% over the same period. Energy goes up, fertilizer goes up, food goes up. The chain is direct, it is documented, and it happens every time the energy market convulses. Asset number 7 is the one that sophisticated investors always include in their crisis positioning, and it's the one that seems the least exciting until you understand what it actually does for a portfolio: U.S. Treasury bonds and the U.S. dollar. When global investors panic, when they don't know whether oil fields are going to be bombed or shipping lanes are going to be closed or stock markets are going to crater, they do something that has been true for 80 years. They move money to the United States. They buy U.S. government bonds. They hold U.S. dollars. Not because they necessarily love America, but because in a world that suddenly feels dangerous, U.S. Treasuries are considered the closest thing to a guaranteed return that exists on this planet. During the October 2023 escalation, the 1-0-year Treasury yield moved in ways that made bonds briefly attractive as hedges even in a high-rate environment. The US dollar index, the DXY, gained against virtually every emerging market currency as capital fled towards safety. You access this through TLT, the iShares 20-plus-year Treasury bond ETF, or through direct Treasury purchases via treasurydirect.gov. The dollar exposure is most easily managed through UUP, the Invesco DB US Dollar Index Bullish Fund. This is not your highest upside position during a crisis. It is your ballast. It is what keeps your overall portfolio from collapsing if the escalation turns out to be worse than expected. The investors who consistently profit from geopolitical crises don't just load up on oil and defense stocks. They structure a portfolio where the safe haven assets offset the downside risk, while the volatile assets capture the upside.